Hello and welcome to ETF Pulse, ETF.com's podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com, with just a slight cold today. Here, as always, with my co-host, Nate Geraci, Nate Stradamus, president of the ETF store. I heard that ChatGPT didn't love that nickname, Nate, but it's fine. We're going to prove ChatGPT wrong. So let's take a quick look at the Pulse rundown. So first up, we're going to be talking about that downgrade on the U.S. credit rating from Moody's, downgrading from AAA to AA1. And we're going to talk about the impact that's going to have on fixed income ETFs. Then we're going to be taking a look at artificial intelligence. Could it be the downfall of ETFs or really stop this ETF boom that we are seeing lately? And then Coinbase is now officially added to the S&P 500. Nate had to talk something crypto, so we will be chatting Coinbase and its addition to the S&P 500 a little bit later in the show. And then we're going to take a look at Morningstar. They did a report on 4 fee trends that we are seeing lately. 3 guesses, if you can guess, which ETF issuer has the lowest fees and is really lowering the bar when it comes to those fees. We'll give you that answer a little bit later. But first up, let's talk the Moody's downgrade. It, of course, sent markets into an absolute tailspin the other day. Nate, as we saw, a lot of investors seem to be unhappy about the news. But I mean, Moody's is one of 3 credit rating agencies. We already got this downgrade from, S&P. You already got it from Fitch. This is just kind of bringing it in line. But there is a very real impact that it's going to have and that it has had on the bond market, right? Because it is pushing yields up as investors are obviously demanding more in exchange for the risk that they are taking on to buy U.S. Treasury bonds. And we are seeing an impact. Or talk to me through your thoughts, I guess, on this news, but really more how a fixed income investor should really be thinking about this.
Yeah, well, first, I would push back on your characterization of setting the markets into a tailspin. I would say it sent the financial media into a tailspin. So look, there's some impact on the bond side. Let me just take a step back. So this probably won't surprise you at all, but from an overall market perspective, and so I'm including stocks here, I don't think this is anything to worry about. I think this is mostly a non-event. Plus, if you remember, Kristin, Moody's didn't exactly get things right back in the 2008 financial crisis. If you remember, they clearly don't have a crystal ball like I do.
I was a sophomore in college. I don't remember.
Let's just say they didn't necessarily evaluate CDOs and mortgage-backed securities the way that they should have. And plus, some would say, and this gets, I don't want to get into, down a rabbit hole, but they also have some real conflicts of interest out there. But let's just put all of that aside. I think the bottom line is this, and really think about this. If the US, if they don't have the highest credit rating out there, then who does? Because the US has the world's reserve currency and we can print money whenever we need to. So if the US isn't AAA rated, then who is?
China, obviously.
Well, but I think if you start there, that hopefully will calm the nerves of a lot of investors. Look, in terms of impact, I will say.
Okay, quick pushback on that. That's almost like presuming that we're rating credit on some sort of curve.
I just think that, again, if you look at the US's position in the world, and particularly around our currency, I just think it's difficult to say that we don't have the highest credit rating. We can quibble around the edges, and there are certainly other countries out there that are in pristine condition in a great spot. I just think you have to start there at a high level. Look, here's what I was going to say. If you look at our country's debt right now, we have something like $36 or $37 trillion in debt. And is that a concern? Yeah, I think that's something that we should be focused on addressing. I don't think it's anywhere near catastrophic, but I do think we should at least be trying to get on top of that debt moving forward. And I think that's a real frustration that people have with our politicians, right? That they just keep kicking the can down the road.
Yeah.
And at some point, if we continue to do that as a country, I do think there is some meaningful risk, because if that debt keeps growing, and especially if interest rates move higher, that obviously becomes much more expensive to service that debt. I believe the interest we're paying each year right now is actually more than our entire defense budget, like just the interest. And so I'm not saying this is a complete non-event. It's just not something that I think investors should be positioning around. Though I will say, and I think you will like this, that at least part of the reason why I have had zero interest in long duration bond ETFs, like our friend, the Widowmaker TLT, I just don't like the risk reward here. And, that's what, if you want to say this sent the market into a tailspin, if you looked at the long end of the curve, we did see rates spike up. And it's just so funny to me because all along over the past several years, we continue to have investors trying to top tick long-term rates, and rates keep moving against them. And so I do think there is some risk. I'm talking a little bit out of both sides, I guess. I just think for the market overall, certainly stocks, and I think for the broader bond market, this isn't some huge issue. I do think longer term, yeah, is there some risk with longer duration bonds? Certainly.
I mean, look, again, markets did open lower that day, and it was like the big news of the day that I know investors were concerned about. But as I mentioned, there's three big credit rating agencies. Two of them had already downgraded, the U.S. credit rating, at least one notch, right?
Well, and real quick, think about that because S&P, that downgrade of the U.S. sovereign debt, that was back in 2011.
2011. And then Fitch,
yeah, think about what stocks have done since then.
Right. And Fitch was back in 2023, so 2 years ago. So again, that downgrade has, at least again for S&P, happened a very long time ago. We haven't moved upward since. I now remember very clearly when Fitch did their downgrade. And I think, again, to your point, investors they heard it. It was very much a news of the day type of headline. I think that kind of helped, or not helped, it really moved markets that day. But I don't think anyone now is really talking about that as a problem or something that they are really thinking about in their portfolio, particularly when it comes to the fixed income and the bond market. Let's just taking a really quick look just at TLT, because it's funny how you're talking about investors trying to figure out this sort of bond market, especially on this longer duration. TLT, just as a reminder for everyone, is the iShares 20 plus year Treasury bond ETF. So pretty much as long as it gets. Fund flows over the last 5 days have been $2.1 billion. And I mean, and now it was its lowest after the news about Moody's. It only was 69 million for Monday's trading session. And I believe this downgrade happened on Saturday or late Friday or something like that.
Friday.
So markets didn't really fully get to digest it until Monday. But still, I mean, we still do see TLT pulling in a ton of money. Which is
that's investors trying to top take rates.
Yeah.
Right. It's
and they haven't been doing well, which is why active fixed income, I think, is really where it's at this year. Because people they've tried and they failed. I mean, if you look at TLT, just when it comes to performance alone, I wish I had an ability to kind of match the performance with the fund flows. But I mean, if you just look out on like a 5-year, I mean, TLT is a roller coaster ride. I mean, there's a lot of reasons for that. But I mean, as an investor, with some of that's why I want to chart this with some of the fund flows to see how investors are kind of thinking about TLT at the same time.
But that's why, if you remember, Kristin, I've talked a little bit about this, and I'm not here to offer investment advice or recommendations. So everybody do your own homework. But I've had a challenge putting something like TLT into a diversified portfolio because if you look at its volatility profile, to your point, it's much more like a stock. It is a much more of a roller coaster ride. I think bonds should serve as a ballast in a portfolio, and it should be a safety. You know what you're going to get out of that. And so, I just don't like the risk return profile of something like TLT. Now, at some point, that could change if long-term rates move high enough. Maybe that there's an entry point at some point down the line, but I don't think we're anywhere close to that. A couple other things. Yeah, go ahead.
Those would really have to rise pretty high for the price to fall. Again, if you're a retail investor and you're unaware, again, remember yields and prices work in opposite directions. I mean, I feel like the yields the way the yields would have to spike for you to get in a price point that makes that risk reward profile make sense for you is a lot.
There's no question. And two other quick things I'll say here before we move on. Just going back to Moody's and all of these ratings agencies, I think they're much more akin to like these Wall Street firms that make these S&P 500 price targets. Like they're always moving the target around. It's always after the fact. My point is anybody really surprised? Like every investor knows the current debt situation of the U.S. This isn't news to me. There's nothing new here. The other thing that I'll say is that, ultimately, if longer term rates do tick higher, because the country's debt situation deteriorates, that can have some impact on consumers, right? Because you might get higher mortgage rates and higher credit card interest rates and those sorts of things. And so it could become a headwind for the economy at some point. But with how much rates have moved just based on this news, again, we're talking a small change, and I don't think it's enough to really change the trajectory of anything here over the short to intermediate term.
ETF Pulse, killing one financial news headline at a time.
That's my goal. I love that.
All right, so let's talk about our next story, which is going to be artificial intelligence. Now, I did not come up with this idea. It was actually a really great article that was that I saw in Axios about how AI could essentially end the ETF boom. It's because there's the online brokerage public created a tool called Generated Assets. And the way that this new tool works is an AI-based tool and essentially allows you to create a stock portfolio from an idea that you might have so that you don't have to pay any kind of, there are fees attached for the tool, but the fees are much lower than what you would pay for the ETF or even an active ETF. So it allows you to put a portfolio together along the same lines of a lot of ETFs, as a lot of ETFs are being crafted. So essentially, you can create your own basket of assets inside your own portfolio without having to go through the process of finding an ETF that you like for it. I don't know if this headline of AI ending the ETF boom is accurate. I actually hard disagree with it, but I am curious to know what you think the role of AI is going to be in terms of ETFs. And if you do think that there is actually a downside to the ETF explosion that we've seen when it comes to artificial intelligence. I actually think it can be in a lot of ways a really good tailwind, but some are seeing it as a headwind.
Well, first of all, I thought it was funny that you brought this up because this Axios article, I'm not kidding you, it was the first thing I saw on Monday morning. I had a long weekend. So my oldest daughter graduated from high school and it was a great weekend. We had a lot of fun, but I was tired. And I see this article first thing. And my initial reaction was like, here we go again. It's another, supposed ETF killer. I feel like we get these every few years. And I was actually going to tweet out a disparaging post about how ridiculous this entire concept was.
Yeah.
But honestly, I then calmed myself down and took a step back. And as I thought about it, I don't think we can rule out anything when it comes to artificial intelligence. It is going to disrupt a lot of aspects, particularly of asset management. So I'm hesitant to just dismiss something like that. That said, there are several things that I think everybody should consider here. And first, I think some people underestimate the convenience factor with ETFs because investors and people in general, I would say, are kind of lazy. They don't want to take extra steps. And I don't mean that in a bad way. What I mean is that people like the easy button approach.
Yeah.
And with ETFs, you pick a strategy, you hit the buy button in your brokerage account, and you're done, right? You can get low cost, tax efficient exposure in 2 seconds. And the way, as I understand it, that this AI process will work, the way it was described in this article, is much more complex because you've got to tell the AI what your strategy is and exactly what you want the rules to be, right? And so that takes some work to come up with. Like you got to come up with those rules and the strategies. And then one other thing, because I get going on this, on that note, and I would say this is much more important, Kristin, you have to remember a lot of ETFs fail, right? And these ETFs are conceived by professionals. We're talking CFAs and highly experienced portfolio managers, very smart people in asset management who are coming up with these ETF ideas. And these are mostly well thought out, I would say, these ETF ideas. And a lot of them aren't having much success, whether because the performance is bad or nobody wants the ETF or both. A lot of ETFs fail. And now with this artificial intelligence, you're telling me we're going to say every Tom, Dick, and Harry out there is basically going to create their own ETF? But we have these CFAs and portfolio managers who have been doing this for a long time. They can't even have success. That just seems like a recipe for disaster to me. And there's a lot that goes into running an ETF in terms of just managing costs and trading and tax efficiency and risk mitigation. And I'm not saying AI can't do this, but the question is, should any random person out there be using AI to do that, right? Like is that how you're going to achieve the best longer term investment returns? I'm skeptical if it's not clear.
I think for me, I think the best kind of point that you made is about how you have to be just like with any kind of AI tool, you're the one inputting what you're going to get back from AI, right? AI, I love AI, I love ChatGPT, but ChatGPT is only as good as your prompt, right? Being a good prompt writer is a skill in and of itself. And now you're adding the extra layer of complexity in terms of how we're dealing with the finance space, where at least, because I'm imagining this is mainly for retail. I doubt that a bunch of FAs are going to be, but I mean, FAs do use AI, but not to say that they don't. And asset management firms do use AI. But what I'm imagining this tool, particularly because it's for an online brokerage, is really for the retail investor to kind of figure what they should be purchasing, stocks or bonds or whatever it is inside of their portfolio. And to your point, I'm not entirely sure if I have enough confidence in the prompts that are going to be written to create the best performing, lowest fee sort of portfolio that can be constructed through this with some of these prompts, right? I mean, direct indexing is very possible now, and people don't do it because they don't want to, because they're lazy. Like, you can go into VOO, see every single company that's on there, and just go down the list and buy them all. I mean, you could even figure out the weighting inside of your own portfolio, right? To construct that. No one's doing that. It's annoying. It's a laborious process, and it's not tax efficient by any means to do that 500 times versus once, for buying the fund. So, I mean, I didn't necessarily think that AI could disrupt. I think it can disrupt definitely the ETF industry. I think it's going to disrupt the financial industry at scale, but I don't know if I see it putting the brakes on the ETF industry in this sort of way.
Yeah, I agree. I think we're saying the exact same thing. Yeah. It's just, you're right. AI is only good as good as the prompts right now. AI is going to continue to evolve. I'm not saying they can't get to a place where there's some really interesting opportunities for investors to take advantage of it. But at the end of the day, it still comes back to the end investor providing it the information. And we know over time that that's typically not a recipe for investment success. And that's really what it comes down to for me. I think there are a lot of other ways that AI will impact financial services and asset management. This just isn't one that I see is any sort of threat. It's interesting. I think it's fun to talk about. But yeah, I'm
who knows?
skeptical.
In 5 years, we might both be eating our hats.
We may not be here. It may be like AI doing this podcast. It won't even be us. It'll be like a replica. We just serve it the prompts.
Like AI versions of us?
Yeah. And I'll be laying on a beach somewhere.
I mean, your lips to God's ears. That'd be great. I would love for AI Kristin to do this. And I could just go hang out in like the south of France or something like that.
I think that's more realistic than it killing ETFs.
100%. 100% agree on that. All right. So next up, your favorite, Coinbase, S&P 500. Now, last time we chatted about it, we kind of touched on it. We didn't really talk too much about it. We just kind of mentioned it. It was about to be added. It hadn't yet been added. It has now officially been added to the S&P 500. What a difference the S&P 500 has had. Several winning days in the markets, I think all down to Coinbase. I'm kidding, of course. But early days, this is, I think, a really big deal. I mean, the fact that Coinbase has been added again, it's clearly being thought of as an integral part of the U.S. economy. It's being it is, right? The S&P does not just sort of add things lightly to its index. But this is pretty huge news. However, there have been some bumps in just the first couple of days. Data breaches, which I think is alarming to a lot of people, especially when it comes to things like crypto.
All right, you're laying a lot out here for me. First, let me just say, I do think this is very symbolic, because to have a highly prominent crypto exchange now included in the S&P 500. And by the way, what's interesting about this is that it replaced Discover Financial Services and the S&P 500. That felt so appropriate, right? And you know what? This actually reminded me of our battle shares discussion last week when we were talking of like the new versus the old. And here you have a crypto exchange replacing a traditional financial services company in the S&P 500 index. I thought that was interesting and very battle shares-esque. But it's been a week for Coinbase. They had that big customer data breach at the same time or right before they were added to the S&P 500. They have a lot of other stuff going on. I will say on the customer data breach, a lot of people are equating that to crypto in some way. Kristin, think about Wells Fargo and Citi and all these other financial services companies that over the years have had customer data breaches.
They've almost every single, I'm pretty sure I can
Yeah.
definitely say that they have all had some sort of data breach, customer information leaked. I mean, at this point, and I mean, I saw an interview, I believe on CBS, like Sunday morning or something like that, where it was that every single person's social security information is purchasable on the dark web. So
Yeah. And so my point though, in bringing that up is that a lot of people are saying, oh, well, here's another crypto exchange that's, been hacked or whatever. That's not the case here. This is because they have know your customer KYC. And that's a requirement of the government. They're collecting all of that customer data. And yeah, it sounds like some employees over in India were bribed or whatever to release this. My point is just that I don't see that as a crypto centric issue. That's
right.
something that is an issue for any financial services firm that collects customer data. The one
I think
difference,
there's a thought that Coinbase ought to be better because, again, it is representative of the future. And we already know that when it comes to the financial services industry, they have been very, very late to adopt technology. I mean, just very basic things that we have in terms of our, debit and credit cards. Chip and PIN was available here years after it had been invented and years after other nations, after other continents had been utilizing it. But then for Coinbase, you figure, but it's supposed to be the financial services of the future that they've somehow managed to create an unencryptable sort of database, or that I think that's.
Well, again, this was employees that were bribed to get the information. But
Right.
however, your point is still well taken. And the way that I would describe this from a crypto perspective is, let's say that you own a bunch of Bitcoin. Okay. And then let's say you also have, I'm just making up numbers here. Let's say you have $5 million with Wells Fargo. So let's say you have $5 million of Bitcoin with Coinbase, and you have $5 million just with Wells Fargo in cash. If your information is leaked or given out at Wells Fargo, somebody can come after you and try to put a gun to your head and say, hey, give me your $5 million. And you may be able to go to an ATM and withdraw a very small portion of that.
Mm-hmm.
But there are some, it's much more difficult, I guess I would say, to get that $5 million moved out of Wells Fargo if you were under some sort of duress.
Correct.
Versus with Bitcoin, that can move like that.
Exactly.
Right? And so if somebody knows you have that 5 million Bitcoin, they're like, here's my address. I know you have it. Gun to your head. Move it.
And there have been kidnapping attempts for people that have a lot of crypto holdings. So, I mean.
So my point is that I think you're right in that there should be a higher bar for somebody like Coinbase around customer data. I think everybody should have an extremely high bar here, but certainly in this field, because of some of the things that we're seeing and the fact that crypto is self-custodial and those sorts of things, it does open up some other avenues for people to be taken advantage of. Putting all of that aside, coming back to the ETF part of this story, I actually blog about this. If you look at the top 3 ETFs by assets, those are all S&P 500 ETFs, mm-hmm. right? We've talked about this. So there's over 4,200 ETFs. The top 3 are the Vanguard S&P 500 ETF, VOO. You have the Spider S&P 500 ETF, SPY, and then the iShares Core S&P 500 ETF, IBV. And then if you go further down the list, there are actually 2 other ETFs in the top 30 that involve the S&P 500. So you have the Invesco S&P 500 Equal Weight ETF, RSP, mm-hmm. and the Spider Portfolio S&P 500 ETF, SPLG. And that's, like the miniature version of SPY. It's at a lower price point. That is a lot of ETF weight that will be thrown or is being thrown behind Coinbase. I think that's significant. And the other thing too, and this is why we talked about this last week, or I brought it up last week. I think we were talking about Vanguard, but I love the irony of Vanguard blocking access to Bitcoin and Ether ETFs. Right. And now
they're going to be
of Vanguard investors, they're going to own the most prominent crypto exchange, or one of the most prominent crypto exchanges, that trades Bitcoin and Ether and all of this stuff. You have to love that. That's symbolic too.
Well, speaking about Vanguard, because we're going to circle back to the question of the day, which is, which ETF issuer is lowering the bar, so to speak, when it comes to fees? So Morningstar had a report out looking at 4 fund fee trends that we have out there. I'll just kind of name them. I have the report up right now. Excuse me. So first up, we have that fees are driving flows. It should come as no surprise that investors continue to prefer, low cost funds. The second up is that Vanguard is the low cost leader when it comes to the fees. And we'll circle back on that. Then we have that ETFs obviously are still cheaper than mutual funds, but mutual funds are catching up, at least when it comes to the lower fees. And so there's obviously an opportunity there, or there is becoming an opportunity for mutual funds going forward. And then last up is that ETFs, newer ones, are becoming more expensive. So there is this sort of, I think, going to be this sort of meeting point between mutual funds and ETFs going forward. But yes, Vanguard is the answer to the question of the day, which is, who is the low cost leader of the issuers? It is Vanguard. It is Vanguard.
Yeah, what was their average expense? It was like 7 basis points across their line?
0.07%. So yes.
Yeah. Well, a couple of things that I'll tack on here is that, and you said this well, I think, but Morningstar estimated that investors saved $6 billion last year compared to 2023.
Yeah.
And the big reason for that is because investors are seeking out lower cost funds. I just think it's important for people to understand this. It's not that investors are necessarily already invested in these funds and then the issuers chop fees. That happens sometimes. But this is much more when investors go to allocate money, they're intentionally seeking out the lowest cost mutual funds and ETFs, right? And there are plenty of those available. Right. And so that's mostly how you come up with that $6 billion. And there
was a stat on that. So essentially, because of the inflows, and remember, we had record inflows, for our listeners, record inflows in 2024, over $1.1 trillion of inflows into the ETF space. Those heavy inflows, which is, again, as you were mentioning, these sorts of new allocations to these low fee funds, it nudged the average fee from 0.36% down to 0.34%. And that's where you come up with that $6 billion of savings, the lion's share of that savings, the $6 billion savings last year.
Well, I was going to say, but let me talk about the fact that ETF fees, like new launches, the fees are coming at a higher price point. Mm-hmm. And so I think you gave the stat that mutual funds have actually closed the gap a little bit in terms of the average fee versus ETFs. Here's what's going on here. If you're an ETF issuer, you're not going to launch another S&P 500 ETF, right? Or you're not going to launch some plain vanilla value ETF. All of that stuff is spoken for. And so if you're going to bring a new product to market, it needs to be highly differentiated. And I would say the more differentiated, the better, if you actually want to have a chance at success. But if you're going to be highly differentiated, that probably means your product's going to be much more complex. And that's what we're seeing. Much more complex products coming to market. And with that greater complexity, there's a higher price point on these ETFs, right? We've talked about that. Think about leverage single stock ETFs and options-based ETFs, battle shares, all of this stuff coming to market. These are much more complex strategies. And so issuers are charging higher fees for that complexity. But from an issuer standpoint, and I think this is the most important point, how do I describe it? If you think about the fact that investors are allocating to the lowest cost funds in their core of their portfolio, and that's how we're getting the $6 billion in savings a year. Investors are only paying 3 or 4 basis points if they want for their core stock and bond ETF exposure. And so if investors are doing that, I think the thought process from ETF issuers is that investors don't mind paying up for satellite holdings. Right? Like if somebody wants to put 3 or 4% into a double leveraged XRP ETF and pay 1.9%, that investor is not really concerned about the price because the other 97% of their portfolio is in low cost, Vanguard stock and bond ETFs. Right. So the fee is just a rounding error. So what I'm getting at, Chris, I think it's both there. I think you have issuers coming to market with much more complex products that somewhat justify a higher fee, but it also just allows the issuer to charge a higher fee for that complexity. And then I think issuers know that because investors are just using these products for a very small sliver of their portfolio, they can also get away with charging a higher fee. That's what I think is going on.
Then there's also the reality that over time, those fees, even of those newly launched fees that have higher fees, will probably be slightly cut.
Yeah, probably just because you have competition, right? It's called the ETF Terradome. If there's a successful product category, competition's going to move in, and the fee will have to come down. So yeah, I agree with that.
Right. Now, what will be the interesting question is if mutual funds ever manage to get their fees below what we see for ETFs, but I doubt it.
Mutual funds will be dead and gone before that happens.
Prediction.
Nostradamus prediction. That will never happen, A. And I think it's, again, much more likely just mutual funds go away altogether. I'm not predicting that latter point, by the way, but
I was going to say, if you were to predict when mutual funds will officially die, when we see the extinction of the mutual fund, what year is that?
I don't know. But it'll happen at some point. I mean, the big, what do they call it? I think Bloomberg's Eric Balchunas calls 401ks or retirement plans like the last Alamo for mutual funds. That's
And
where they're
people are
making their
fighting
last
them.
stand.
People are fighting them. And I think they should, because we should be allowed to invest in ETFs in your 401k.
Well, yeah, some platforms do allow that.
Some do, but I just mean at scale, because for most
sure.
people, they don't and they can't. And it's always some boring, 50-year target date fund that no one understands and knows. And you get this long prospectus that's like 50 pages long.
You want a double leverage XRP ETF in your 401k, don't you?
Yeah, I do. I absolutely.
Only 3% though.
I absolutely.
No more.
100%. I want to be able to put crypto. I want to make my entire 401k crypto. I think that'd be a great idea. Well, that's it for this week's ETF Pulse. I was contemplating talking about mid caps, but we're not going to. Nate said snore about it, but we'll see if I can.
Maybe next week.
If I can't wrangle a mid cap conversation next week. If you are, please have a good Memorial Day weekend, and we will catch you next week for ETF Pulse.